All right. Today is Wednesday, October 27th. This is a recap for the stock market activities today. Folks, I got a good one for you tonight, and here it is. In focus tonight, we have a massive warning from the bond market. And then we're going to talk about the Washington, DC Whorehouse. We have to pronounce it that way because the robot police might pick up on something. And lastly, let's talk about corporate earnings because they continue to jack up prices higher and higher and higher as inflation continues to eat away their margins. We start with the warning from the bond market, not just the US bond market, but the global bond market. And here it is, bond traders' mood turns sour as yield curves flatten all over the world. What does that mean? Well, here is the yield curve in the US, and in a healthy yield curve, the longer end pays more than the shorter end. What does that mean? It means the 30-year bond should be paying more than the 20. And the 20 should be paying more than the 10. And then the 10-year should be paying more than the 5-year. And the 5-year pays more than the 3-year, and so on and so forth. What do we have right now in the current yield curve? We have the 30 and the 20 paying pretty much the same. This is what it's called flattening, the flattening of the yield curve, which is not healthy, by the way, because at some point we can get into a phenomenon called inverted yield curve. And as you can see, every single time, the yield curve inverted, it was a precursor, a predictor of an upcoming recession. What we have right now is flattening on the long end of the yield curve, the 30 and 20. That tells us that bond investors have less faith in the long term of this country, that the future is not bright. And when you look at the yield curve in other countries, it's even worse. So the global sentiment on the future health of the global economy is souring tremendously. And the reason is we have inflation surging out of whack, globally of course. Meanwhile, incomes and purchasing power for consumers worldwide are dropping tremendously. And this, of course, is forcing certain central banks to tighten their monetary policy abruptly. Take, for example, the Bank of Canada, which announced today that they're foregoing altogether their bond purchasing programs, aka the cocaine operation, and they're also thinking about jacking interest rates higher. Here we go. The surprise element when inflation surges out of whack, forcing central banks to raise interest rates abruptly. Of course, the Fed is lagging. The Fed is behind the curve here. And if the action from the Bank of Canada is a leading indicator, then the Fed will have to follow because we have the Bank of England also doing the same, the Bank of Australia. Every central bank across the world is freaking out about inflation. But it doesn't matter if the Bank of Canada or the Bank of England hike interest rates higher. At the end of the day, the central bank of the world is the Federal Reserve. And if the Fed continues to be quote-unquote accommodative, then all of these tapering operations and raising interest rates will not do the job in curbing inflation in these countries. They remain at the mercy of the action or the inaction from the Fed, the Federal Reserve, the central bank of the world. The take here is the Fed says we're going to taper by about $15 billion a month. That's baloney. That's garbage. $15 billion a month is not going to cut it. They're going to have to cancel all asset purchasing programs abruptly, MBS purchases and bond purchases. And perhaps by that time, this action will not be enough on its own. It has to be accompanied by an abrupt interest rate hike. And this should be scaring the markets and market participants. But market participants remain in denial. They continue to buy the dips. They continue to cling on the hope that the Fed will not do anything. They're just bluffing and inflation will just go away. It's going to be transitory. I say it's time to wake up. Next, let's move on to Washington, D.C., aka the Whorehouse, because we have a massive inflation problem. Food prices are surging out of whack, costing the American consumer an arm and a leg at the grocery store. Everything is surging higher. Gas prices, rents are going higher. Utility bills are going higher. Everything is going higher. And now even food banks are struggling with the rise of food inflation. The Fed remains in inaction, of course, in complete denial and delusion. And then we have the federal government also in denial, delusion, and then some. The Biden administration wants to spend on steroids trillions and trillions and trillions of dollars to fulfill their campaign promises. Now, here's the problem. Of course, more spending, trillions more in spending, will contribute to moving inflation higher and higher and higher. With that being said, the country is in desperate need of infrastructure spending. We need to spend at least $1 trillion in pure infrastructure spending. Otherwise, we're going to fall behind the Chinese. You go to China for a week or two and you land back in LAX or LaGuardia and you're going to feel like you just landed in a third world country. So we do need pure infrastructure spending. The problem is that the Biden administration would add a bunch of stuff, useless waste, hopes and dreams within the bill. Promises here, promises there. You're going to get money. You're going to get money. He's going to get money. She's going to get money. Everybody's going to get money. And of course, all of these are false promises and nothing will happen. At the end of the day, they're going to pass a lousy deal that passes more cash to their billionaire donors, and you and I will get nothing, zero, nothing at all. The main question is, who's going to end up paying for all of that? Now, before we start, you know my stance about the so-called billionaire tax bill. It's garbage. It's not realistic. You cannot tax somebody for paper gains, for something they did not realize. And I told you the solution is taxing share buybacks and eliminating tax credits on interest payments for billionaires. But the point of the story is to present two whores for you in DC who are vehemently defending their billionaire pimps through the end. They have no problem with spending trillions of dollars on waste, but they are objecting to making the billionaires, their donors, their pimps, to pay for it. Whore number one is West Virginia Senator Manchin. And I know what you're going to say. Oh, bro, this guy's a straight shooter. Really? I think Alec Baldwin is a straight shooter, not this guy. Because today, once again, he defended the billionaires and his donors over and over and over again. He has no problem with spending trillions of dollars in waste. He just doesn't want his billionaire donors to pay for it. He wants you and I to pay for this garbage. Senator Manchin says, on the billionaire tax, he does not like targeting different people and that the ultra-wealthy have contributed to society, created a lot of jobs. Really? Oh, the discrimination against the poor billionaires. Oh, what a heartbreaker. And first of all, Senator Manchin, the ultra-wealthy did not contribute shit to society. They did not create jobs. The economy created jobs, not the billionaires and the trillionaires. Soon enough, we're going to have trillionaires, by the way. When you talk about contribution, is it really contribution, Senator Manchin? Or is it theft? Because this is what actually happened. The Fed printed trillions and trillions and trillions of dollars out of thin air. They added that to the public debt. This money is stolen, keyword stolen, from the country, from the new generation, the Gen Zers, the millennials, the Xers who are about to retire at some point. This money was stolen from them and got passed to the stock market, the Fed, the assets purchasing programs, quantitative easing, and the so-called accommodation for Wall Street and the billionaires, leading stock prices to surge higher and higher and higher. We have a hypermania bubble in the stock market, hyperinflation of assets prices. These so-called billionaires that you're defending right now, their wealth increased by trillions of dollars, not because they created new products and services and they hired more people. Their wealth surged higher due to the cocaine operation of pumping the stock market higher by the Fed from stolen money of the taxpayer. They sat in their asses all day long looking at the screen, their portfolios, going higher and higher and higher without contributing anything at all to society. The distortion between fair market values for these companies and where their stocks are trading right now is obscene, and this is due to the stolen money from the next generation of Americans. And I say, if we're about to spend on steroids trillions and trillions of dollars, the most beneficiaries of this rigged economy, the billionaires, should be paying the tab, not the poor and the middle class who lost their savings, lost their small businesses, lost their incomes in this pandemic. Joe Biden says, rest assured, I'm not going to tax anybody who's making less than $400,000. Well, who's going to pay for all of this? Trillions of dollars. Who's going to end up picking the tab? The answer is you and I. And we have whore number two, Senator Sinema from Arizona with the denim, she's in a rodeo, who's, by the way, has zero interest in this job whatsoever. This is just an audition for her to get a corporate job after losing the re-election. Their sole purpose is to defend their billionaire donors through and through, because who's going to end up upgrading Senator Manchin's yacht? It's almost heaven right now. The guy is looking for actual heaven. He needs more money. And we now know the billionaires like Nelson Peltz, for example, admitted that he calls Senator Manchin pretty much every single week and says, "Good job, stay strong. We don't want to pay more. We have no problem receiving more, but we're not going to pay more." And I say, you know what? This whole thing is a money laundering operation anyways. If the government ends up passing the so-called infrastructure plan, trillions and trillions of dollars, and the ultra-wealthy pays for it, well, guess what? All of that money will be passed back to the same billionaires who got taxed because their companies are going to do the job. Government contractors. So I say to billionaires, the likes of Elon Musk, for example, what are you pissed off about? Pay $30 billion in taxes, and then the federal government will hand you back $100 billion to do the so-called infrastructure. If you think about it, Elon, this is easier than your stock surging higher by over 10% in a single day. And of course, surprise, surprise, the so-called billionaire tax is gone. No good. And the question remains, who's going to end up paying for all of this spending? If the billionaires are not paying, who's going to end up paying? Hint, you and I. And the solution for now, before they say, okay, you know what? Yeah, we're going to tax you folks who are making under $400,000. Your taxes, we said, they're not going to go higher by a single penny. We lied. It's actually going to go higher by about 15 to 20%. Sorry. And the other solution is they have to continue to trim the so-called Build Back Better plan, whatever that means, and they continue to trim the spending lower and lower and lower. By the end of this deal, you're going to get nothing, and the infrastructure spending will get reduced to nothing. And all in all, the donors and the Smithsonian Museum magically will get a few billion here and a few billion there. That's the entire purpose and the end result from this so-called Build Back Better plan, because an actual infrastructure spending bill will have to be financed by increased taxes on the ultra-wealthy, the billionaires and the likes. Well, this is not going to happen because we have two senators who would rather default the country on its debt than making the billionaire donors pay more. The billionaires have your beloved politicians on speed dial. Take, for example, Paris Hilton, who visited Congress and the Senate last week, and all of these politicians met with her. They're taking selfies. One billionaire can get your top senators to sit down with them for hours to listen to their problems, channeling their inner shrinks, because God forbid the billionaires might suffer here and there. They might have some problems. And I say, you know what? How come they're not wearing masks when Paris Hilton is around? Because this girl has more STIs and viruses than the Wuhan Institute of Virology. Next, let's move on to earnings. And I want you to reach to your pocket, feel your wallet. Is it fat or is it thin? Do you have cash in there? Do you have a lot of cash? Good. Now I want you to make more cash. Go ahead, make more cash. It's easy. Just buy Shiba Inu, because the prices you're about to pay in the grocery store and otherwise are going to continue to go higher and higher and higher. U.S. companies to keep prices high as supply chain headaches persist. The largest U.S. manufacturers, including General Motors, General Electric, 3M, Boeing, face logistics headaches and higher costs due to global supply bottlenecks that are likely to persist into next year. But agreed, the hit to profits can be mitigated by charging higher prices for their goods. Ta-da! Companies across the globe sounded the alarm on supply issues months ago that have pushed prices higher in raw materials from chemicals to steel. In earnings reports this week, investors got a closer look at how companies are managing. It starts with really strong price, said GM Chief Executive Officer Mary Barra in a call with reporters. We were able to do very well with full-size trucks and full-size SUVs. We just cannot build enough of those vehicles. General Electric also expects supply constraints to persist through the rest of the year and in 2022, hurting profits in its healthcare business. Boeing also complained of a quote-unquote severely weakened supply chain. The pandemic has crippled many companies' abilities to send and receive the parts and supplies needed to make a wide range of products, creating shortages, reducing inventories, and hammering profits. On Wednesday, Harley-Davidson said it increased surcharge pricing in the United States to offset higher raw material costs. The motorcycle maker expects these costs to remain high, and it is exploring higher surcharge costs globally. Harley-Davidson said the inventory shortage is also squeezing its international market share. McDonald's also said it had to raise prices in the United States. Industrial giant 3M cut its full-year earnings outlook on Tuesday and said it would increase product prices to combat inflationary and supply chain pressures. The company, which makes a long list of building and construction products, said it was facing higher costs related to things that I cannot pronounce, and labor. It added that the global semiconductor crunch would continue to weigh on its automotive and electronics end markets. On Tuesday, Lockheed Martin, this is part of the military-industrial complex, they are also getting hit, dramatically lowered its sales expectations for the year, saying the pandemic has hobbled the top U.S. defense contractors' supply chain. Its shares fell more than 11% on Tuesday. Lockheed's chief financial officer said the problem worsened for them over the last 2 months, as the maker of the F-35 fighter jet lowered its 2021 revenue expectations by 2.5% to $67 billion, and said next year's revenue could fall to $66 billion. And here are the earnings reports in details. And once again, as market participants, we're looking for companies with pricing power, companies that are exercising their pricing power, and the consumer is reacting positively to higher prices. And today we got earnings from some of these companies, but let's start by Boeing, because Boeing reported in the morning and we were expecting higher delivery numbers. This is the report from last time around. The backlog grew to 4,155 planes and they delivered 79 planes, including 47 of the flying coffin, the 737 MAX. And I told you I'm looking for higher numbers here in deliveries. But pay attention to the margin, by the way. The revenues and operating margins. The operating margin was down 7.8% last quarter. So how did Boeing do this time around? Here it is. The backlog of orders is now about 4,163 planes. They delivered 85 planes last quarter, including 62 of the flying coffin. The problem is their margins went down by 15.5%. Here we go. Inflation is eating their margins away. When we look at the defense, space, and security segment of the business, the margins were up 6.6%. But before you get excited, this is actually down from last year because the operating margins for this segment was 9.2% year over year. So again, inflation is eating away their margins. When we look at the global services segment of the business, the margins were up 15.3%, and this is an improvement year over year. This is the only segment of the business that Boeing has total control of. It's actually monopoly. Who's going to fix the planes and maintain them? The answer is the maker of the plane, Boeing. And therefore, they have the ability of jacking prices higher in this segment, not in the defense or commercial airplanes businesses. And Boeing says they expect to restart the 737 MAX deliveries to China during the first quarter, CEO Dave Calhoun says. And by the way, I dislike this guy. I think he's a lousy CEO. And this garbage of saying we're going to deliver 737s to China by early 2022, really? Have you looked at the Chinese economy recently? Are they going to be able to pay with all the problems in the Chinese economy? I say this is a long shot. Next, we have Coca-Cola, a company that I own in my portfolio, and it is an excellent inflationary hedge. Here it is. The CEO was actually ahead of time, by the way. He already saw this happening, and he started jacking up prices back in April. And this is paying off, and we're seeing Coca-Cola's margins, revenues, and profits surging higher. Now, Coca-Cola says we expect the shortages to last all the way through 2022. So there is no relief in sight whatsoever in this supply chain crisis. And guess what? Coca-Cola will increase prices again and again and again with no stop in sight. Prices will continue to go higher. So long as they continue to have the pricing power and the consumer responds positively, those prices are going to continue to go higher and higher and higher. And here are the financial results from Coca-Cola. Their operating margins were around 29% year over year. This is an improvement of about 229 basis points. So their margins continue to expand higher. What about the gross margins? Year over year, the gross margins were over 60%. This is an improvement of about 51 basis points year over year. They continue to expand the margins. This is good. The net revenues grew 16% to $10 billion, and the margins, all in all, were 29% versus 26.6% in the prior year. Therefore, the earnings per share, the EPS, grew 41% to about 57 cents. Again, this is a classic inflationary stock that continues to perform and continues to deliver. Next, we have McDonald's, another classic inflationary name. Their sales went higher by 9.6% year over year. This is a dramatic improvement from the 4.6% growth last year. Likewise, the total revenues for McDonald's in the quarter were up 14% year over year. On the other hand, their expenses were up about 11% year over year. All in all, the net income was up 22% year over year. So what happened here? Because costs continue to surge higher. What was behind the dramatic surge in revenues for McDonald's? Here's the answer, and you guessed it, higher prices. McDonald's higher U.S. menu prices fuel earnings beat, chain raises sales forecast. And hold your horses here, they're gonna jack prices higher and higher and higher. McDonald's raises menu prices as U.S. workers' wages climb higher. Wage inflation has the ripple effect of companies hiking up prices for us, the end consumer. And with this labor shortage, wages are going to continue to rise higher and higher and higher, meaning the prices that you and I are going to pay are also going to go higher and higher and higher. And the way inflation works is, whatever penny extra you get in wages, you're going to pay two more in rent and living expenses. McDonald's and Coca-Cola shares jumped Wednesday after the companies reported rising demand even in the face of price hikes. The restaurant chain in particular pointed to higher menu prices in the U.S., boosting comparable sales almost 10% above Wall Street's expectations. We haven't seen, I'll say, any more resistance to our price increases than we've ever seen historically, McDonald's CFO Kevin Ozan said on a conference call with analysts. The company, which boosted menu prices 6% recently, used third-party firms and customer surveys to help it determine prices and gauge sentiment. The latest bump, quote-unquote, has been pretty well received by customers. There we go. This is a company you want to be in this massive inflationary environment. On top of that, McDonald's, recognizing the labor problem and the hike in wages, they are now working with IBM to automate their drive-through lanes. And the goal here is to cut wages by eliminating certain employees. And therefore, McDonald's can hike prices higher while eliminating certain employees by automating their drive-through lanes. Therefore, their margins will improve in the future. This is exactly the kind of company you want to be in right now. Next, we have GM, General Motors. What's going on here? The problem is their net revenues were actually down quarter over quarter and year over year in North America. But even more problematic is their EV sales were down dramatically quarter over quarter and year over year. When we look at the Chinese numbers, sales were actually higher. The revenues were actually higher quarter over quarter, not year over year, but quarter over quarter. The market did not receive the earnings from GM positively. And I do believe that the lackluster numbers in EV sales in North America and other markets, on top of the misses in revenues, impacted the stock negatively. Now, there are certain geniuses, the shorts of course, who decided to short Ford right after General Motors' earnings. What do you know, Ford reported after the build, and they actually beat in certain numbers. Big upside surprises, and now the shorts have to scramble and cover, and therefore, Ford stock is surging after hours. And as you might know, I own the stock of Ford. I'm in Team Ford. And Team Ford is doing pretty good against all the odds, by the way. The chip shortage, inflation, yada, yada, yada. All in all, the revenues were up to $35.7 billion. This is an improvement from last quarter, be it not an improvement year over year. But the market was not mad at Ford because the abysmal numbers from GM lowered the bar for Ford. What am I talking about? Here's what I'm talking about. North America, the revenue was up quarter over quarter, yet down year over year. However, their EBITDA margins were also up quarter over quarter. Everybody was afraid that revenues will be down quarter over quarter, just like we saw with GM. But Ford managed to deliver. You're going to see the secret here in a minute. When we talk about South America, we know this is a weak spot for Ford for many years. but Ford managed to deliver and beat expectations. The revenues were up quarter over quarter, and they were the same year over year, but their EBITDA margin improved dramatically quarter over quarter and year over year. Now, when we look at Europe, they also beat year over year and quarter over quarter, and this is the secret. Pay attention now. Their margins improved dramatically quarter over quarter and year over year. And the reason is strong sales for the Mustang Mach-E, the electric vehicle from Ford. So when the Tesla culties say, woohoo, there's no competition, where's the competition? Tesla's a monopoly, Ford is a dinosaur. Really? Because sales of the Mach-E are surging higher in North America and in Europe. And by the way, the stock performance, Ford is beating your ass year to date by a lot. Tesla has to double in value to catch up with the performance of Ford. So who's the dinosaur now? When it comes to China, Ford is also delivering, by the way. Wholesale units are up quarter over quarter, and they're on par year over year. The revenues were also on par quarter over quarter. EBITDA is improving. When we look at international markets, Middle East, Australia, etc., this is the weak spot for Ford. The revenues were down quarter over quarter, year over year, and the EBITDA margin was also down quarter over quarter, be it up year over year. We also have a positive catalyst here for GM and Ford. These are the union companies, of course, because EV tax credits are now up to $12,500. But the boost depends on the so-called Biden's agenda. I had no idea he has agenda, by the way. What is the agenda, Mr. Biden? He wouldn't even know how to answer that question. And here's another one for you, just to pump up your optimism about the future. We almost had the biggest labor union strike in Hollywood's history. This was averted because we have negotiations now. And part of the negotiations is increasing the pay for union workers in the streaming business. What does that mean? The monthly membership prices that you pay for streaming will also go higher and higher and higher. This is of course good for Netflix, but specifically for Disney. Disney's jacking prices for park tickets. They have the pricing power. They're also about to jack up prices for the Disney Plus streaming service. So Disney is a good stock to be in right now. Anyhow, let's move on to the market's coverage today, starting with the performance. And here we go. The Dow Industrial Average closing in the red, down 265.40 points, or a decline of 0.74%. The Nasdaq pretty much on the flat line, nothing is going on here. It was actually trading higher, thank you to the morons who shorted Microsoft and Google last night. They got caught with their pants down and they had to cover, and therefore the Nasdaq outperformed the rest of the market. Absent of that, the Nasdaq should have been down big, but regardless, the S&P 500 was down 23.11 points, or a decline of 0.51%. Moving on to the sector's performance, what's going on here? Leading the pack at number one, you guessed it, capturing the gold medal too, communication services, aka Google. And at number two, forget about it, we're not going to give number two. Or number three, no medals. Communication services is going to get the gold, the silver, and the bronze, because every other sector of the market went down, led by energy, financials, and materials. The inflation trade got whacked today. Interest rates went down, and by the way, you shouldn't be celebrating interest rates going down, because if anything, this is not a sign that inflation will ease. It is a sign that inflation is too much of a problem. It will cause a recession sooner or later. Moving on to the ratios, advanced decline ratios, NYSE an abysmal 21% advancing versus 77% declining. The Nasdaq, similar story here, 27% advancing versus 69% declining. The Nasdaq was led higher by two names, actually three, Microsoft, Google, and Tesla. Absent of these three, the Nasdaq should have been down big. Moving on to futures, what's going on here? A down day for the inflationary trade led by energy. Crude oil prices are down big, over 3% for the WTI, and over 2.5% for Brent. Gasoline prices, this is a relief of course, they went down by about 6% today. Likewise, heating oil prices are down. The problem is natural gas prices continue to be resilient. The short covering is extreme here, and natural gas prices advanced higher by over 2% today. What about softs? Lumber is giving some of the gains from yesterday, down about 4.5% today. Likewise, we have declines for coffee, down a little over 3.5%. On the other hand, we have gains led by sugar, OJ, cotton, and coca, all trading higher. What about metals? We have a mixed picture here. The defensives, gold and silver, pretty much on the flat line. The offensives, platinum, copper, and palladium are down big, over 2% apiece. What's going on with meats? I told you live cattle futures are going to surge higher. Meat prices are going to continue to go higher and higher and higher, and we have live cattle futures up by around 3% today. And here it is, the new big tech is back. Lean hogs futures are up over 5%. On the other hand, feeder cattle futures pretty much in the flat line. What about grains? We have gains led by corn, canola, soybean meal, and wheat futures. On the other hand, we have declines for soybean oil, while soybeans, rough rice, and oats are pretty much in the flat line. Watch out for wheat prices surging out of whack, because the French are livid about wheat prices surging out of whack. Rising wheat prices have French fretful over the cost of baguette. See, in America, the red line is Big Mac prices. Big Mac prices going higher. That's it. Mr. Powell is over. You gotta taper now. You gotta raise interest rates now. We had it with this inflation. For the French, it is baguettes. And I always get excited when the French get mad, because they're not mad about submarines this time around. But when the French get mad, I get nostalgic to the old days, the good old days. And you know what? The good old days are coming back. Not just in France, but worldwide. I would say before 2050. So if you want a sure bet, 100% guaranteed, you might want to buy call options on guillotines. They're going to make a comeback. Let's get the heads rolling. Let's get the ball rolling. Anyhow, moving on to the big casino, the options market. What's going on here? Leading the pack, the hottest table by far remains Tesla, the souffle, with about 1.4 million contracts traded today. About 43.5% of those were calls. Notice the put-to-call volume, or ratio, I should say. They're buying more puts now. What does that say? This latest pump is about to be dumped. Surprise, surprise. Although the culties remain relentless, somebody actually bought 2,000 contracts of the 2,000 calls with the expiration date, you guessed it, this upcoming Friday. Then we have at number 2, AMD. AMD continues to outperform, but it is down today. The volume was about 950,000 contracts traded today. About 70.5% of those were calls. And at number 3, Microsoft. It was up big today because the morons who shorted the name yesterday. Why would you short a name before you get the earnings? Doesn't make sense at all. Because they got caught with their pants down. They had to cover big and they skipped the NASDAQ elevated today. Microsoft, the volume was about 800,000 contracts today. About 72% of those were calls. Notice Morgan Stanley, by the way, the ticker MS. Really weird here, because Morgan Stanley is not active, at least it's not popular in the big casino. But somebody's going on here. Something is brewing in Morgan Stanley. Moving on to the unusual activities that took place in the options market today, starting with the ticker KWEB. This is the Chinese technology ETF. They're buying puts now, the 43 puts for the expiration date, January 21st of 2020, with the expectations that the name could go down by more than 14% by then. And they paid all about $1.45 a piece, all in all spending about $3 million. What about NVIDIA? Everybody is excited, of course, about the metaverse. Is it going to be a bust? Buy the rumor, sell the news, who knows? But they're buying calls, the 260 calls for the expiration date this upcoming Friday, October 29th, with the expectations that NVIDIA could pop higher by more than 6% by then. They paid about 30 cents a piece to enter this trade, all in all spending about $500,000. What about the trade for the ticker BKKT? The name was up big. Then it went down big, and now it's up big again. This is a casino. There is no rationale whatsoever in trading this name. But they continue to buy calls now, the $30 calls for the expiration date, November 19th, with expectations that the name could pop higher by more than 9% by then. They paid $6 a piece for this trade. All in all, spending about $8.5 million. Then we have the trade for TSLA Tesla. They're buying calls, the 1,110 calls for the expiration date, October 29th, with the expectations that TSLA could pop higher by more than 7% by then. By then, we mean Friday. They paid about $3.30 a piece to enter this trade, all in all spending about $3.8 million. And there is something floating around, by the way, from the culties. If we push the price higher to elevated levels above 1,000, Elon Musk will announce another stock split and then the stock will shoot up higher. When will this stupidity end? What about the trade for the ticker XBI, the biotech ETF? They're buying calls here, the 135 for December 3rd, with expectations that the name could pop higher by more than 10% by then. They paid all about 85 cents a piece to enter this trade, all in all spending about $850,000. What about the trade for the ticker TAN, T-A-N? This is the solar ETF. They're buying calls here, the 105 calls for the expiration date, November 19th, with expectations that the name could pop higher by more than 10.5% by then. They paid about $1.20 a piece to enter this trade, all in all, spending about $1 million. Lastly, what about the trade for the ticker GTLB, GitHub? They're buying puts here, the 85 puts for the expiration date, January 21st of 2022, with expectations that the name could crash by more than 20% by then. They paid about $4.50 a piece to enter this trade, all in all, spending about $3.3 million. Moving on to the heat map analysis, what's going on here? Nothing is going on. Everything is down. Financials are down. Healthcare is down. Energy is down, industrials are down, materials down, utilities down, REITs down, everything is down, with the exception of three names that rescued the market today. Number one, Microsoft. Number two, Alphabet, and this is due to the morons who shorted the market yesterday, shorted these names specifically, and now they got caught with their pants down, and they had to cover today, pushing these stocks higher. We also have Tesla trading higher by about 2% on the news that Uber is now buying 50,000 souffles. You know what? I'm going to order 500,000 souffles, because you put them in the oven, boom, they're done. It's not like you need chips, aluminum, steel, software, nothing. You just place an order and they come right out of the oven. Boom. Here's the problem though. Is Tesla about to be a cabbie car now? An Uber car? And how would the virtue signaling elite in Malibu and Silicon Valley and the likes feel about driving a cabbie car? What does that mean? The upper class who are buying Teslas right now and they're going to switch to Audis, Porsches, and Mercedes. Because who wants to drive a cabbie car? You need a little class when you virtue signal, right? We also have Visa down big due to earnings. And this news, by the way, that we got today, the Justice Department is scrutinizing Visa's relationship with large financial technology companies as part of its antitrust investigation of the card giant. But you know what's working today? It is also the consumer giants with the pricing power. I'm talking, of course, about McDonald's and Coca-Cola. Moving on to charts, starting with the SPY 30 minutes chart. What's going on here? We had the bear flag, and the bear flag is playing down. Or playing out, I should say. The support is 454. It is already broken, and the likelihood is the gateways to hell will open. What do I mean by that? We took the escalator higher. We're about to take the elevator down, closing some of these gaps. It's not just earnings coming out short, with inflation crushing margins, and of course companies jacking up prices higher and higher and higher. It is also this lousy deal, the so-called Build Back Better whatever. The market was pricing in a $1 trillion plus plan, specifically over $2 trillion. Now we're down to $1.5 trillion. And by the time the deal is done, we'll be down to $1 trillion, if not less. So the market has to price out the reduction of the bill. It has to take out about $500 billion to $1 trillion out of the recent rally. And here is the daily chart for the SPY, the continuous contract. What's going on here? We have the shooting star and we have the confirmation of the reversal. This is also accompanied by elevated momentum indicators, the RSI, the MACD, all topping and curling down. The volume elevated higher. So you have the pop, you have the shooting star, you have a damn candle with a higher volume than the preceding candles. This is a confirmation of the reversal. The support for now is 4,549.5. The likelihood is this is not going to last. And the market might flush down, all the way to 4,384.5, erasing all of these gains. It will all depend, of course, on the big ones that we're about to get tomorrow. Apple and Amazon. Moving on to the Qs. What's going on here? The Qs had a bear flag too, but we had the cute rescue this time around from Google and Microsoft. This is not going to last. The short covering will be over. They're going to start to dump again, and the Qs will flush down all the way to the support at 372 at a minimum, if not below that. The only rescue for now, the only validation for any rally in the Qs is the fact that the 10-year yield went down. But I caution here, heed this warning. The drop in interest rates was not due to our concerns regarding regarding inflation being alleviated. It is due to our concern the bond market market concerned, that is, that inflation is surging out of whack and at some point it will lead to a recession, and therefore the higher end of the yield curve, the 30 and the 20, are dropping like a rock. And here is the daily chart for the continuous contract in the Nasdaq. The momentum indicators are already topping at elevated levels. The volume is surging higher. We had the shooting star, but no follow-up here. We had another reverse hammer, shooting star, whatever you want to call it, perhaps a double shooting star. Doesn't matter to me. The psychology is more important than the pattern. What do you call it? The psychology says the Nasdaq went higher twice and it got rejected. This is a reflection of the contrasting energy in the market right now. On one hand, we have buyers buying the dip, excited about the earnings from certain technology companies. On the other hand, we have the resistance, the other side of the market that says earnings are not that good, by the way. They're okay, but they're slowing down. We have many other problems now. The budget deal is not going to happen, and if it happened, it's going to be a lot lower than we thought. And inflation is eroding margins even in these lean tech growth momentum stocks. Even these companies that we thought will be immune of this inflation, they're getting capped too. You want to talk about a warning sign? Here it is, the IWM, the Russell 2000, a 30-minute chart, dropping like a rock. We had the bear flag, the rejection from the resistance at around 229, and here it comes, flushing down all the way, only saved by the bell. It could have went down all the way to the last support for now at 223, and perhaps it would go down there tomorrow, if not closing the gap below that. This is not a good sign when you have the so-called leading indicator of the market, the Russell 2000, flushing down like this. Again, I'm not a believer in the leading indicator theory, but if the cyclical side of the market flushed down like this, then this is yet another validation that the Qs was saved by the short squeezes in Microsoft and Alphabet. Moving on to the Dixie, the dollar index, what's going on here? The dollar wants to pop higher. The behavioral element of the chart says the dollar wants to pop higher. It got muffed today because the Australian dollar also surged higher. We got the inflation data from Australia. It came out hotter than expectations. And therefore, we have yet another central bank around the world also tightening policies. What is the Federal Reserve waiting for? And I say that the dollar is about to pop higher again. It is not just confirmed by the behavioral element of the chart. It is confirmed by the weakness in metals and crude oil. Moving on to gold. What's going on here? Gold still yo-yoing back and forth within range. The truth is, if the dollar pops higher, gold will flush down. And we have a trading channel for now. Some would call a wedge channel. Doesn't matter to me. But we've seen this channel before, as you will see in a minute, by the way. In the 10-year yield chart, this pattern was broken to the downside. So who's to say that gold is not going to break down too? And here is the chart of the 10-year yield. We had the channel, a positive channel with higher highs and higher lows. The channel is broken now to the downside. The good news is that yields did not mark a lower low, at least for now. The reversal will be confirmed if yields close below 1.5% by the end of the week. But for now, who's to say that yields are not going to form a higher low and continue to be resilient from this point on, consolidating above 1.5%, building energy before it pops higher again. And perhaps we can get a better perspective here from the TLT's chart, a weekly chart. It is surging higher now, reversing the negative divergence on the RSI and perhaps soon enough in the MACD indicator. If it closes the week above 149, then the bear flag goes down the toilet and we have something else brewing here. Moving on to the VIX 4 hours chart, what's going on here? It continues to build on momentum. Look at the MACD indicator. It's about to cross the neutral line. The green candles, the green columns on the MACD indicator are getting bigger and bigger and bigger. So far, we're up about 17% from the bottom, but the likelihood is if we have a pop in the VIX, it's going to build on more gains, eyeing the destination of 20 by the end of the week. We know the crush the VIX Fridays and the battle of 20. The bears want to close the VIX above 20 by the end of the week. The bulls want to crush the VIX by Friday. Moving on to Apple, a daily chart. What's going on here? It is just consolidating underneath 150, the resistance, building the bull flag pattern. This is an opportunity, of course, to buy some options. If you are super bullish on Apple and you have a degree of certainty that it's going to pop higher after earnings, this is the time to buy some call options. On the other hand, if you're bearish with a degree of certainty that Apple will flush down after earnings, then this is the time to buy some puts because the premiums get cheaper as the stock is consolidating underneath 150. This is an opportunity for me for a calendar option strategy. The problem is, do you bet up or down? Do you buy calls or puts? For me, it all depends on the greater China sales number, and I cannot predict that, of course. So I'm staying out of this one. Moving on to Tesla. A daily chart, what's going on here? We had the shooting star pattern, followed by another shooting star. This is the Christopher Nolan pattern. A shooting star within a shooting star within a shooting star. Yet if you remember the definition of a shooting star reversal pattern, it is not applicable here, because we should have had a flush down candle, a red candle today, with higher volume than the previous 2 days. We did not have that, but we're having a double shooting star pattern. It is still a negative pattern, indicating that perhaps the prop is running out of gas. And when you investigate the reason, the mechanical reason behind the prop, it is due to the options market mania, buying calls on steroids. The majority of these calls were bought for the expiration date of this Friday. So if the stock fails to pop higher by tomorrow, they're going to start closing these calls at a loss or at a smaller profit than expectations, and the energy will wash away, shifting from bullish the bearish, and here comes the reversal, working out the so-called overbought conditions in the RSI indicator. Moving on to tulips, but before we do that, we have news from Mama Cathie Wood. You know, Reverend Elon talked about inflation and rising prices and yada yada yada. And I have a feeling, by the way, that Mama Cathie is not a fan anymore of Reverend Elon. After the betrayal, the so-called betrayal, with Elon talked negatively about Bitcoin, but she is becoming a fan of Twitter CEO Jack Dorsey. So she's buying the dip in Twitter and Robinhood again. She's dumping the winner, Tesla, and she's using that money to buy the dip in Twitter and Robinhood. This is the beginning of the end of the reign of Tesla witch Cathie Wood. We also have this revelation, by the way, a little disturbing when you look at the details and who's controlling the tulip market. Just 0.1% of Bitcoin miners control half of all mining capacity, according to new study. So who's pumping, who's dumping, you have no clue at all. If the stock market is a jungle, the tulip market is a swamp. And here's the chart of BTC. What's going on here? We had the bear flag, and the bear flag is playing down. We have significant loss in momentum from the MACD and the RSI indicators. The volume is climbing higher on down days. All of these are bad signs that BTC will go down to a minimum, the support of 55,300. Moving on to AMC, 30 minutes chart. What's going on here? We have lost the support of 36.5. The chart is flushing down, perhaps all the way to the support, the next support of 32. There are a lot of distractions here, and the so-called apes are stabbing each other in the back. There is no huddle here. There is no apes. There is no teams. There is no tribes. Stock market investing, every man and woman are on their own. You buy, you have a goal, you achieve the goal, in, out, hello, goodbye. The team and the herd mentality, the cult mentality will cost you a lot of money. What is the distraction, by the way? The number one distraction for the ape community. Here it is. Shiba Inu. It is popping higher significantly today, more than doubling. And look at the chart. Just look at it. There's nothing to analyze here. It can go up, it can go down. There is no way you can figure that out. There is no fundamentals at all. There is no utility at all. This is the classic definition of a tulip. Look at the guy and the gal next to you. Are they willing to pay more? And if they are, then Shiba goes higher. If not, then Shiba goes down. Simple as that. There are no fundamentals, no utilities, no revenues, no earnings, no profits. It is just how much the sheepy next to you is willing to pay. And this is, of course, sparking the war, the tulip war, between Team Shiba, and Team Doge. And I say if two tulips want to go at it, bring on the popcorn. And of course, the mania reached extreme levels in Shiba, the point where Coinbase went down. But if you thought that was disturbing, I got even more disturbing news for you. Did you know that Shiba Inu has a bigger market cap than Yum Brands, than General Mills, than Hershey's, than 7-Eleven, than Discover Financial, HP? It is even bigger than the NASDAQ. D.R. Horton, Nokia. It has a larger market cap than Etsy, Robinhood, Pinterest, Best Buy, Kroger, Southwest Airlines, Delta Airlines, Warner Music Group, Caesars Entertainment, Viacom, CarMax, Take-Two, Kellogg's. Shiba Inu is bigger than all of these companies. Now ask yourself a question. Does it make sense? At all? Of course not. You and I know that. The culties trading these tulips also know that. But everybody's dancing, assuming that the music will continue to go on and on and on. Lastly, moving on to earnings previews. What do we have on the earnings calendar tomorrow? We have Merck before the bell, and we have Caterpillar. Then after the bell, we have Starbucks, Apple, and Amazon. Another critical day for the market. And by the way, we have a little teaser for you from Starbucks. Starbucks is raising prices higher. The minimum wage all the way to $17 by 2022. As if Starbucks is saying, you know what, the report coming out tomorrow, it's not going to be good because we're jacking wages higher. If we cannot pass the extra cost to the end consumer, then the company does not have the pricing power. Do we have any history that Starbucks has the pricing power? I don't think so. What I'm asking you is, if the price of a cup of coffee in Starbucks goes from $5 to $6, will you stop drinking coffee from Starbucks? If the answer is yes, then the company doesn't have the pricing power. If the answer is no, then the company has the pricing power. But this is just a little teaser that even Starbucks will contribute more to inflation. When it comes to Apple, the number is Greater China. How are sales doing in Greater China? Amazon, I think it could beat here because the expectations are a lot lower than last quarter. When it comes to Caterpillar, I'm worried about the numbers from China. We have a massive slowdown in the Chinese economy. How would that impact Caterpillar numbers? When it comes to Merck, it's all about the approvals, the clinical studies regarding the pill, the upcoming COVID pill, and how fast the FDA can approve it. Lastly, what do we have on the economic calendar tomorrow? We have, per usual, the initial jobless claims for the week. We also have pending home sales, and this will be important for the housing market. The expectations are a massive drop in pending home sales. And with that, ladies and gentlemen, I'm done here. Thank you for watching. Thank you for listening. And I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.